Hi, so in this video I will give a brief overview over the difference between capital expenditure and revenue expenditure. So if we get straight into it, we need to first discuss what each of these types of expenditure are, and then it should become quite clear what the difference is. So it's on screen here. We'll start with capital expenditure. So when we talk about capital expenditure, we're talking about expenditure on the acquisition of long-term assets, or we're talking about expenditure to improve the earning capacity of long-term assets. So the key terms here are obviously long-term, and so we can either buy new long-term assets. So let's think of some assets such as factory equipment if we're a manufacturing firm, so machinery, but not just acquiring new long-term assets. This could also be to improve the earning capacity of our existing ones. So again, if we think of the factory example, instead of only buying new machines, we could also be spending on innovation in order to improve our existing machines. And so this could be, say, coming up with a new software or anything to do with something that will enhance the earning capacity of our existing assets. But this has to be improving the earning capacity, so our capital expenditure is going to increase the value of our long-term assets, and these two criteria cover those or that point. So as we say here, capital expenditure refers to non-current assets. We've discussed this in a previous video, with non-current sort of linking into this long-term idea, assets that are going to last us more than 12 months. And these non-current assets are going to be recorded in the statement of financial position. Again, a financial statement which we discussed in a previous video. So that's what capital expenditure is. What then do we mean by revenue expenditure? Well, this is going to be expenditure for trade purposes. What do we mean by trade purposes? Well, this could include purchases of raw materials, spending on wages, finance costs, or selling expenses. So there are loads of trade purposes we can have, but you'll notice that these are more short-term expenditures. So for trade purposes, if we are producing goods, we're going to need the raw materials, or just the materials that we need to actually make our good. We're going to be spending on wages of our staff members. Again, that we can almost view this as a sort of raw material. It's an input to our production process. So wages for the staff who are going to be producing our good. We also have things like finance cost and any expenses for selling. But these are all, they're very different to capital expenditure, which is on our long-term productive capacity. This is sort of our short-term expenses. We already have our production capacity, and these trade purposes are the expenditure once we have our production. It's just actually using it. And so all of these expenses are sort of, we are just producing the goods, and it will cost us this amount. We also have spending to maintain the existing earning capacity of long-term assets. So this is maybe subtly different to the point with capital expenditure. However, it is quite different. So we're maintaining the existing earning capacity. So what do we mean by this? Let's go back to our factory example with machinery. What if one of our machines breaks down, or we have a fault with it? Well, if we spend to fix our machine, or say to clean our machines or anything like this, this is not going to increase the earning capacity of our assets. This is going to maintain it. If our assets break down in some way, we're going to have to spend on maintaining the existing earning capacity and get it back to working as normal. And so this is revenue expenditure. So anything like that. So that is sort of the difference. Our capital expenditure we can think of more as a long-term investment, as we say, long-term, and it's going to increase how much we can produce. Whereas our revenue expenditure, we think of it more as a short-term thing, and we already know what our overall productive capacity is going to be, and revenue expenditure just actually goes about in the short term, making our goods, being able to produce our goods for our customers on a day-to-day basis. So this revenue expenditure is recorded in the statement of profit or loss. We talked about that statement in a previous video as well, so check out that if you haven't already. but hopefully those key differences between these two are clear. If I was to try to make it easier to remember, we just think of capital as long-term and revenue as short-term, but there are a lot more subtleties to these expenditures than that. So if we can try and remember these two criteria for each of them as what they include, then we'll be well on our way to explaining the difference between these two types of expenditure. So that will wrap up this video. Please do leave a like rating if it was at all useful. Check out the accounting playlist for more accounting concepts, and subscribe to add some econ to your subscription feed.